Do you track EduComp at Kotak? That's taken a bit of a knock, Sanjeev, these last few days after it said it would securitize its smart class revenues.
No, we don't, but something like that is clearly not a good signal. I mean, it's basically a case of the company pulling its revenues forward, and at the same time, there's a mismatch between revenues and expenses clearly. So if you have, such, rather I don't know, for the sake of something else to say, lose accounting policies, clearly the market is not going to favor such things.
You spoke about the energy sector. We were just speaking to the IOC chairman a couple of days back, and he said that GRMs had collapsed to $3 and with no great prospect of moving up in the near term. But what does that mean for earnings? I mean, when everybody talks about Reliance, everybody's terribly focused on the settlement and what the gas dispute. But what about core earnings?
Core earnings are going to be quite horrible this quarter. I don't think there is any denying that. It's rather bizarre that all the attention is focused on some gas discovery, oil discovery, or settlement and whatnot. But the fact of the matter is, this quarter earnings numbers quite bad because you have very weak refining margins. In fact, refining margins are actually negative. If you see Singapore margins, they are negative by a fair margin. No pun intended over there. So clearly margins will be bad as far as refining is concerned. Chemical margins have come down over the last 6-7 weeks, again quite drastically. And the whole problem is I don't see either chemical refining margins improving in a big hurry. I mean, clearly they will improve from where they are because we can't have negative margins for a long time. But since June, actually, Singapore refining margins have been negative the way we compute it. Coming to Reliance numbers specifically, if you see the first half numbers, they have done about 46 rupee EPS. We have 97 for the full year. I think that's looking a bit of a stretch, but I'm completely confounded and confused by consensus. I mean, it's at 116. I don't know what people are seeing over there. But there's no way the company can deliver even close to 100 rupees EPS, assuming things continue the way they are. And it looks like both chemical refining margins are going to be pretty bad for the second half. So I'm pretty astounded by consensus numbers over there. Even next year, people have 150 odd rupees of EPS, which I think is just way too high. So I would be seriously worried about downgrades coming in case of Reliance, and it's a big component of the BSE 30. Ultimately, it's about 12% in terms of earnings contribution. And similarly, in case of ONGC, also I'm getting a bit worried if crude remains at 80 and the government does not give any or take any portion of the subsidy on auto fuels, and if the government-owned upstream companies have to bear 100% of the auto fuel subsidy, which was the case in the first half, then you will have again very bad numbers for ONGC also in the second half, and that would actually be a big negative for the market as well, because we have 30% of earnings ultimately coming from the energy sector.
What about telecom? Have you reworked targets there, Sanjeev, either by way of earnings or price?
Oh, yeah, we have done. In fact, we have always been somewhat cautious on the sector. So our fair value now for something like Bharat is about 320. For Arcom is 150. But I don't think there is any big hurry to rush into the stock, even if the current prices are somewhat close to where our target prices are, because I think the environment will be pretty bad for the next 6-7 quarters. I don't think things are going to improve in a big hurry. Consolidation is way out for people to start playing it immediately. You haven't even seen some of the operators starting operations, somebody like Etisalat or Unitech, Telenor, or for that matter even Tata Docomo in several circles. They have yet to start operations. So I think the pricing environment will remain very bad and could even worsen from where we are. Keep in mind the fact that most of the price discussion which is happening is in the prepaid segment. Going forward, at some point in time, you will see mobile number portability coming in, and you could see the same madness spreading to the postpaid segment also. You could probably see handset subsidies and whatnot coming to the market. So that's going to be a big, maybe the second or the last shoe to drop as far as the telecom sector is concerned. So stay out of it. No point, even looking at it for the next, I would say, 3-4 quarters.
What remains your high conviction overweight right now, Sanjeev?
Okay, that's a good question to ask. Honestly, not too many stocks which you can look at from an absolute perspective in terms of making say 15-20% from where we are, because most stocks have become very fairly valued as far as large caps are concerned. Some of the PSU banks still look okay, but most of them are now trading at pretty much the high end where they are trading in terms of price to book. But I think once people get a little bit more comfortable that the NPA problem is largely behind us, you will see NIM expansion going forward, and also loan growth coming back, because the first half numbers have been quite weak as far as loan growth is concerned. And with last data which came out, you have loan go down to less than 10%. But once you start seeing some of the infrastructure projects getting rolled out, and credit growth picking up, then maybe you could still see some of the stocks performing. I mean, some of the stocks which you could still look at is maybe a BOB or a Union Bank, which are trading at about 1.2, 1.3 times price to book, and most of the PSU banks still deliver pretty high ROEs. For example, your Union Bank would be about 21% ROE for fiscal 2011 on a price to book of about 1.3. Similarly, Bob would be at about 1.2, 1.3 price to book on about 16-17% ROE. So I think these are some of the banks you could still look at. Other than that, honestly, from an absolute perspective, return perspective, I think there are very few stocks which you could look at seriously and hope for a 10-15% return.
Sanjeev, within infrastructure, you're positive on a couple of construction stories like IVRCL and Nagarjun. What's the story there?
Well, they're okay on valuations, they're not very expensive. And the thing is, once the government starts awarding all the infrastructure projects, you could see earnings starting to surprise a little bit on the upside. These companies are sitting on a fair amount of order book anyway, so I don't think the earning numbers are going to be too much of a negative surprise should be there. Going forward, the government has, as you know, been talking a fair amount in terms of new infrastructure projects, whether be it on the roadside or irrigation or whatsoever. Now, once those start coming through, I think people will start taking a lot more confidence in the fact that your 011, 012 numbers will be a lot better than what is the indication at this point of time. And that should be the driver for the stocks. Valuations are quite okay. I mean, I think both the stocks would be somewhere about 11 or 12 times on 2011 basis. So clearly there is scope for both earnings upside, and once that comes through, you would also see multiple stocks expanding from where we are.
What about cement then? I mean, there's been some volatility in that sector, Sanjeev. The results weren't bad in this quarter, but people seem to be quite circumspect. Are you?
Yeah, we are cautious on the fact that you would see cement supply-demand balance deteriorating quite significantly from where we are. If you see the supply-demand balance between 2010 and 2011 fiscal years, you are seeing something like 55 million tons of new capacity getting added. Compared to that, with incremental demand, even in the best case scenario, would not be more than 35-40 million tons. So you would see operating rates dwindling down to somewhere about 80%, which means the pricing pressure could start building in. If one of the guys become more aggressive and starts increasing market share or in quest of market share, so that could break down the pricing arrangement which has worked so far in the industry quite well. Already you are seeing prices in Andhra Pradesh have been coming down quite significantly, and I don't see the reason why it shouldn't spread to the rest of South India also. In North, prices held up reasonably well, but I think even there, once you see the new capacity of JP etc. coming on, you would see a similar issue there too. We are building in a price decline of about 10 rupees per bag for next year, but even in that kind of scenario, we're still looking at this company doing very well as far as cash return on cash invested or ROE, ROC is concerned. So I don't rule out further weaknesses as far as cement prices are concerned, particularly if some companies decide to become aggressive on pricing in order to place the volumes and increase market share. So that could be a real problem for the sector.